Hello and welcome to Views from the Lake. I'm your host Alex Chalekian of Lake Avenue Financial. We're at a very interesting point in our nation's economy. The US dollar keeps strengthening against other currencies. The Dow, the Nasdaq, and the S&P 500 are all hitting all-time highs. And the federal funds rate is at the lowest it has been since the 50s. Now, for those of you who are not familiar with the federal funds rate, this is the interest rate at which a depository institution lends funds maintained at the Federal Reserve to another depository institution overnight. Now, let me translate that into plain English. The federal funds rate is the interest rate that banks lend to each other, and that is the rate set by the Federal Open Market Committee, better known as the FOMC. The FOMC is the Federal Reserve's primary monetary policy making tool. So what does this all mean to me, and why should I care? Basically, the higher the federal funds rate, the more expensive it is for you and I to borrow money. Now, the opposite holds true as well. So as I mentioned earlier, the federal funds rate is at rock bottom and has been there for a while. So what would happen if the FOMC decided to finally raise interest rates? The last time they raised rates was 2006. That's almost 10 years ago. Now, recently the Fed has hinted that they are ready to raise rates again, and the world has been patiently waiting to see what they're going to do. So while we wait, I thought it'd be a great idea to discuss how rising interest rates would impact you and the economy. One of the ways it would affect you is an immediate raise in the interest rate that you're getting in your savings or money market account at the bank. Most savings accounts these days are barely paying any sort of interest. Most of us actually find it laughable when we check our statements to see what the rate is. Well, if interest rates rise, then you should see a rise in the interest you receive in your bank accounts. Don't be surprised if it takes the bank a little while before they start to raise the rate. You and I know that they're in no hurry to pay you more money than you have to. Unfortunately, the low interest rate environment that we have been trapped in for so many years has done nothing but punish the savers. Many retirees that lived off of the interest that their bank accounts used to give them were forced to take on more risk than they were comfortable with and started to invest in the stock market and bond market to get a better yield. This is one of the many reasons why you see the markets at an all-time high. Part of the manipulation that the FOMC is guilty of is that they're taking the stock market to these levels. Keep in mind that the Fed's job is not to interfere with the market, it is to control monetary policy. But that's a whole other topic, and we'll cover that in a separate video. So what happens to bond investors when the Fed decides to raise interest rates? Well, bond prices and interest rates have an inverse relationship to one another, meaning when interest rates rise, bond prices drop, and vice versa. Now, a rising rate might not matter to you if you are a bondholder and you plan on holding your bond till maturity. But what if you don't want to hold it till maturity? Or better yet, your bond gets called and you need to figure out what to do with your cash. This can get a little bit tricky. There are certain fixed income investments that actually thrive in a rising rate environment. It's always a good idea to contact a firm like Lake Avenue Financial that specializes in fixed income investing. We can always help guide you with our unbiased advice. Well, we talked about the bond market, but what happens to the stock market? This low interest rate environment has been a blessing for corporate America. Being able to borrow at such cheap rates has allowed public companies to expand as well as buy back their own stocks. This, coupled with slow wage growth, has made these companies more profitable than ever. But once rates start to rise, you should see that profitability start to wane. For starters, stock buybacks will slow down. This has been a big Wall Street trick to make publicly traded stocks look like they're actually having record profits, even though their sales are the same or declining. Second, the more expensive it is for these companies to borrow money, the less likely they are going to be spending money on expanding their business. It is common to see the stock market sell off when the Fed starts to raise rates. That means they are starting to take their foot off the gas pedal and let the economy slow down. Lastly, for those of you who are shopping for a home or currently looking to lock in an interest rate on a 15 or a 30-year mortgage, you might be in for a surprise. When the US Treasury rates move up, you can pretty much bet that the interest rate on conventional mortgages will soon follow. This will also affect those of you who took out an equity line of credit on their home. Most of these lines of credit have a variable rate, so as interest rates rise, so will the rate on your equity line of credit. Now, this is a bit of a slippery slope. On one hand, the Fed has backed themselves into a wall and will eventually need to raise rates. But on the other hand, the Fed is afraid of shooting themselves in the foot if they raise rates too quickly and kill off the growth in the real estate prices. Just like bonds, real estate prices tend to have an inverse relationship to lending rates. This might not be true all the time, but as the rates for a 15 or 30-year mortgage rate increase, you will see a slowdown in home purchases, thus pushing the real estate market lower. The Fed is cognizant of this and wants to try to keep the residential as well as the commercial real estate markets propped up for as long as they can. Don't forget the power of the wealth effect. The higher an individual's real estate price goes, the wealthier they feel and the more they will spend. So what have we learned? Though we don't have a crystal ball and can't predict the exact day the FOMC will decide to raise rates, we do know that it's going to happen. So the most important takeaway from this video is, are you prepared for when the Fed does raise interest rates? For those of you that are watching this video, we're offering a complimentary stress test of your current portfolio. We'll be able to show you how your positions would perform if interest rates spiked. Click on the link below to get started. There are no obligations for this complimentary service. All you need to do is answer a couple of easy questions and we'll take care of the rest. Thank you for watching. We'd love to hear your comments. To watch some of our other videos and read our blog posts, please visit our website, lakeavfinancial.com. There you'll be able to subscribe to our weekly newsletter. You can also find us on Twitter, LinkedIn, and Facebook. And remember, at Lake Avenue Financial, we manage your wealth with your goals in mind. Thanks for watching.